The issue with a lot of price action patterns is that it lacks context. People just show patterns, but it lacks context. Now, one of the things for me when I first got involved in trading, when I started off, my dad was trying to figure out how to trade when he owned his aviation business, and he was having me help him. Essentially, I was like a clerk for him, where every night I would cut out the future section of the Wall Street Journal. And we had an Apple IIe computer, which was like the revolutionary computer at the time, the Apple IIe. And we could actually generate price charts. Very few people could had price charts back then, but I would take the Wall Street Journal and I would hand punch the open, high, low, close, volume, and open interest for all the futures contracts. And then from that, we could generate price charts. So out of that, I would watch the volume and open interest every day when I would hand punch this into the Wall Street Journal. Then fast forward, I go off to school and I made a decision to work at the Chicago Board of Trade full time during the day while I went to night school full time at night. So my college experience was going to night school. And I worked at the Board of Trade during the day. I learned finance at night. But then in the middle, there was a college in Chicago called Illinois Institute of Technology, or IIT. And IIT actually had technical analysis classes. And so I signed up for those and I would go to those classes when my workday was over, but my night classes hadn't started yet. So, I mean, I was living trading like the whole day from 7 in the morning to 9, 10 at night. And I remember taking early classes and they would talk about price action and they would talk about volume. And so there's these standard tenets about volume. And those standard tenets are basically volume tells you the strength of a move. And so if a market rallies on strong volume, that's bullish. If a market rallies on low volume, it's divergent. And conversely, if a market breaks on strong volume, it's bearish. And if it breaks on low volume, it's divergent. So I accepted that premise because that's what I was told. And then I would work with a lot of traders who thought the same thing. But what was interesting is when I actually went through and I started using volume, I saw that that tenet failed a lot. And look, nothing is right all the time. We know this. Nothing works all the time. So if something's working 70 for 75% of the time, that could be a really good edge that you could maximize, that you could monetize. But this isn't what I was talking about. It wasn't that it was wrong. It was how badly it was wrong at the most important times. So I'd accept this tenant. And we get a breakout on strong volume. And I'm like, here we go. This is it. This is bullish. And I'd buy it. And I'd watch the market collapse. And I would start to find that the stronger the volume flows, the bigger the range, the worse it was. And I go and I talk to a lot of my friends. I hired the head technician from Paul Tudor Jones. I hired the head technician. I brought him to Chicago and I made him the head technician for my firm. And he would come in and he would teach classes on price action and all these other things for my traders. And I went to him, I said, look, Scott, I've used volume for years. And honestly, I tell you, I don't think it works. I don't think it works. And I explained to him why I felt that way. And I said, tell you what, I want you to go do a research project and I want you to come back and show me. I want you to validate for me why this works. So he came back. We're in the conference room. You know, we got the big whiteboard and the projector, and he's walking through and he's showing me all these charts of volume and he's explaining it to me. And I started asking him questions about, okay, well, in this situation, we've had this big breakout up on earnings and the volume is high. Why is it failing? He couldn't tell me. He could not tell me, right? This is somebody who's an expert. And I hold him in high regard. So it's not even a slam on him. But in this one thing that he really believed in, and I knew so many people that believed in, it did not work. I walked out of that meeting and I'd already made his decision years back, but I'm like, fuck it, I'm not using this. I didn't use volume for almost 15 years at all. I built a whole structure of trading, a whole structure of reading the market, and having charts that I call the method. And the method did not have volume in it. And it worked pretty damn well, but it didn't have volume in it. So then I'm running my CTA, managing money for clients. We're doing really well. Our performance is really good, but I'm seeing the same thing. I'm seeing these certain situations that the market looks really bullish. And in my trading career, whenever something looked really bullish, I'd do it bigger. I'd do it bigger. So now I'm transitioning into this, and here's these really bullish setups. They look really big. I'm like, really, they look really good. I put them on. Bam. And we lose money. I was a good risk manager, so the losses were manageable, but they still, for me, were too freaking big. And I'm like, what is going on? I also have trades I'd enter, and I thought I was getting at I'd had a good level. I had volatility based stops. I planned all this out. I researched it, put the trade on, and now the market sells off, and bam, stops me out, and then takes off without me. And I watch it like really take off, not like a little bit. And again, I'm making money, but I'm like, how do I maximize who I am as a trader? And I'm looking at these scenarios, and I'm like, this is not, something's off. So I finally said, fuck it. I'm going to go figure this out on my own. I told my clients, I said, I'm not going to trade. I don't know how long. I'm going to tell you it's probably going to be 2 to 3 months, but I'm not sure. And if you feel that you really need to have your account traded, then let's just give you the money back right now. But I'm only going to do what I'm capable of doing. And I'm not going to trade for you in this window. You got to figure out whether you want to stay or not. So I went off and I started researching, and I started looking at all these different aspects of volume. And when I did it on my own, I started to notice some things I had not seen before. I started to be able to answer these questions. I started to be able to fill in these blanks about volume. And in doing so, I started to be able to create volume maps where I knew where the market would pause, or I knew where it would accelerate. And then in addition, I started to be able to go in and look at what was happening in those areas. And I started to be able to use volume and price action patterns to be able to reduce the amount of risk I took, and thus increase my potential R, but also increase my probability. Now, I'll tell you, as a trader, for me as a trader, one of the strongest desires I have as a trader is I have no issue being wrong. None at all. Does not faze me. All I want to know is that when I'm wrong, I'm wrong. That's all I want to know. I don't want to get whipsawed. I don't want to have been right and lose money. I don't want to have a great idea, get knocked out, and see it take off without me. I just want to know that when I'm done, and I'm fine. And so going through this framework, what it did is it started to be able to create points that I absolutely knew that I was wrong. Now, this has a whole nother level of meaning. It has a whole nother level of meaning. Any of you that have worked closely with me, you know how passionate, how important I think creating trading plans are, creating strategy plans, doing scenario planning. I can tell you without a doubt, one of the biggest differentiators you can make between you and people you compete against, one of your biggest edges, is your ability to do great plans with great scenarios. So what's involved in a scenario plan? A scenario plan is being able to map out different scenarios where you do really well or you do bad, and to know in advance what action you're going to take. Now, when you do the scenario plan, When you first set it up, if you don't like how bad it is, then that tells you need to do something when? Right now. You need to hedge it now. You need to reduce the size of the trade now. You need to do something now to get the scenario manageable. But then once we have the scenario manageable, then we have a map, we have a plan. And so when the markets start, like what's happened in the last 6 weeks, there's a lot of people that made a lot of money. And names like Robinhood or Palantir or names like this, a stock, Walmart, like the stocks are taking off. And they're feeling really great about their trading. And then in the last month, they've gotten their ass kicked. And they're sitting there asking themselves all kinds of questions about what the fuck just happened. Everything was looking good, and now it looks really bad. And you know what? This is not the first time this has happened to me. Keeps happening. And you start to doubt whether you even be able to make it because, geez, every time I make money, I always have doubts if it's real. So if I listen to Chuck, Chuck tells me don't take my profits too early because I just screw myself. So I don't do that. But then I get a big profit and I watch it just collapse on me. This doesn't have to happen. And a big part of where this stops, where this does not happen, is in the scenario planning. We plan all this in advance. Where am I going with this? When you understand price action, your scenario planning goes to a whole nother level. When you understand price action, you know where you're wrong. And if you know where you're wrong, you can then have a scenario plan in advance that addresses you being wrong. Things you can do right now before you're ever wrong that help. And then things that you'll do when you are wrong that will get you out. And so you can take a trade like the ones we've talked about, like a Robinhood or a Palantir or something like that, where the trade was taken off. And you can be doing things in advance because of price action to address it. And then you'll know where you're wrong and you're out. And when you do this, you're capturing huge parts of the move. And this becomes money you can actually spend. This becomes money you can actually count on. That's the frame of this. So we're going to talk through today. We're going to talk about price action versus indicators. Biggest myths about indicators and why most traders rely on them. We're going to go through we're talking about a 3-second test of how you can trade profitably without indicators. We're going to talk about how price action reveals the market's next move before indicators confirm it. We're going to talk about 2 core patterns that every market move stems from. We're going to go over the hierarchy of indicators to understand what role do indicators play. I'm not an advocate of saying, there's people that say, just give me a clean chart. That is not me. There are indicators that are really valuable, but we have to understand the proper context for them. Most traders are trapped in what I call the indicator illusion. You could go on to TradingView right now, or you could go to TradeStation, or you could go on to Google, wherever you want to go, and you could just start looking at all the indicators that are out there that are available for sale that you can buy to trade outright or to add it into your trading package. And they've all got a story behind them. So people look at these and they say, well, every time this indicator crosses over, the market bombs and takes off. This is amazing. This is what I want to do. But there's a lot that goes into a chart that if you're new, you don't understand, you don't perceive. Another way of saying this is that your charts lie to you. They lie to you. In hindsight, trades look beautiful. It's easy to see the pattern. But in the midst of the pattern forming, you don't see all the information. You see bars forming. And sometimes they look really bad and they end up looking really good. Sometimes they look really good and they end up looking really bad. We don't know. So when people get into indicators, they are thinking it's going to help them predict the future price movement. The reality is the market only reacts to price data. It only reacts to what's going on right now. Another thing is people think the more indicators they have, the more accuracy they have. But if people don't understand the purpose of the indicators they use and they start adding more, they can actually get in a position where they conflict and then they don't take action. And there's a myth that all successful traders use indicators. The best traders rely on price action and volume. I use indicators. I absolutely use them, but I understand their place. I understand their purpose. And we're going to go over this today. The reality is, if indicators worked as most traders believe, 90% of traders would not fail. The real edge isn't waiting for lagging signals. That's the real problem with indicators. They always lag. They're always late. So you see the entry in hindsight, but you don't see the loss. You don't see the loss when it occurs. Because the reality is, in some of these cases, the chart is telling you to get long. You get long, and then it falls apart. And when you go look at the chart, there was never a signal. But you were long and got stopped out. It's because it lags. What if you removed all the indicators from your chart right now? Could you still find a trade? If I just gave you bars, if I just gave you volume, could you find a trade? And that's something, if you can say yes, then you have an edge. And this is something that you can build on. If you say no, this means that you're using lagging tools and you're missing the real clues in the market. So what's the fix? The fix is to learn how to read price action. And what's great about this is you can take this back to what you were doing before. I'm not telling you that you need to start over and wipe everything clean. In some cases, this is going to be the thing you need to get you over the top. This is going to be the thing that takes you from good to great. It's not necessarily just scrap everything you've ever done. What would be useful is go look at everything you do, understand the purpose of why you do it. And if the purpose isn't clear, it's got to go. Then you bring price action in and how it links with those other things, and then you have a powerful frame. That's why this workshop that we're doing, it works for everybody. We can have people come in with very different methods and very different systems, and this will still work. So indicators are like watching replay. Price action is like watching the game live. So if you think about it, a breakout indicator confirms, but it's confirming after the market's already broke out. An RSI overbought signal appears, but price is already reversed. The moving average crossover happens, but the entry is already too late. What price action traders see first is they see key levels where buyers and sellers are positioned. They see things happening before the breakout is confirmed. They see shifts in momentum and order flow before the indicator confirms it. And they see volume imbalances and rejections before the indicator catches it. There's two core patterns that every market stems from. Every market, regardless of time frame or asset, stems from two core price action patterns. If you master these, you'll have the foundation for every high probability trade. The first is an expansion move. This is where you have strong momentum, big volume, and aggressive orders. This is the fuel behind the breakout. This is the fuel behind trend continuation. And it can be the fuel behind key reversals. The second pattern is compression, trading range, in which you get slow price action, declining volume, and trapping traders. Compressions are the precursors to explosive breakouts and explosive trends. This hierarchy, I encourage you, all of you, to make sure that you write this down and you understand it, and you take this and you be very honest with yourself about where your method, where your indicators, how you trade, how does it stack up inside of this hierarchy? What do you do inside of this hierarchy, and what don't you do? This is a phenomenal schematic for you to identify what you do well and for you to find your holes. So there's 6 components that sit inside this hierarchy. So I want you to notice there's a dotted line right here. Anything above the dotted line is a leading indicator. This is something that leads the market, that you can see happening and you can make decisions right now. Everything below the dotted line is lagging. It's derived from what's above. And just briefly, want to come over here and we look to the right. Professionals Pros focus on volatility, volume, and order flow. That's their big three: volatility, volume, and order flow. The bottom three are where the average retail trader focuses. So we have order flow, volume, volatility. We have one I'm going to come back to. We're going to tell you right now. And then we have trend, and we have overbought and oversold. So the hierarchy, the way I want you to think about this is how an order comes into the market and then impacts the market and thus impacts all the indicators. You can also think of it as a map of lag. The lower it is on the scale, the more lag there is in the indicator. So order flow is the most leading indicator, and it is the first component, is the first sign that somebody wants to do something. This can happen in the screen when you see an order come into the order book. This can happen over the counter when a broker gets on the phone or on DM and starts asking different people for quotes and starts to disseminate a bid. This is the first time we know that somebody wants to do something. And this has value. If we go through and we look at a firm like Citadel Securities, biggest market maker in the world. I haven't looked recently, but I can guarantee you that Citadel Securities is paying somewhere between 1 and 2 billion, 1 and 2 billion a year for order flow. So they go to places like Schwab and TD Ameritrade, and they say, hey, we'll give you $750 million this year if we get to see your order flow. Why would they pay $750 million? And they don't even have a guarantee they're going to make a trade. Why would they do that? Because that's how valuable the order flow is. And I can give you two examples. This is what Citadel does. Citadel they'll have a rule or a system or however you want to call it. So like in the options market making space, let's say, any order that is less than 20, 25 contracts is never hedged. They never hedge it. And why do they never hedge it? Because this is retail order flow. And in the mind of the institutions, retail order flow is stupid, ignorant, emotional, and it's small. So it has big edge, no risk, and is on the other side of the trade is typically people that don't know what they're doing. So they trade with the retail traders, they trade the 20 lots and they don't hedge them. And they'll just keep trading, and eventually they'll buy something here, they'll buy something there, but they're in no hurry. But if an order comes through to buy 2,000, to buy 5,000, something much bigger than 25, immediately they start buying everywhere else. Immediately. They're playing a giant correlation game. So if a big order comes into SPY, well, they can buy Qs and they can buy Russell and they can buy Dow. They can buy E-minis. They can buy micros. They can buy SPX. They can go 500 different ways to hedge off selling SPY. But they also know if the order is big, there's going to be impact. So what are they going to do? They're not only going to buy SPY, they're going to buy everything else. Waiting for this order to pay up, pay up, pay up. And they're going to lift their offers, and they're going to race the bid. And they're going to have offers up here waiting. And they might sell a little and raise the offer. And they might sell a little and raise the offer. But as they're doing this, they're buying around it. They're buying around it. And they're collecting edge everywhere. And finally, this 10,000 lot orders filled. Bam, 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 bam. Now they have a bunch of spreads on that have massive edge in them. And they say, okay, we'll just trade out of those over time. The order flow is worth billions to them. That's why they pay so much. Every prop firm is going out and hiring quants from MIT, using machine learning, using AI, You name it. They're going and get the best of the best of technology and the best of the best of brain power, and they're using them to solve order flow problems. Just let that sink in. That's how important it is. Every market maker leans on order flow. All right. So with order flow, if order flow transacts, it becomes volume. So everything I just said about order flow, there's another side to it, which is an order. We can have a large bid in the market and we can lean on it. We can game it. We can do all these sort of things. But we actually don't know if it's real. You ever thought of that? We don't know if that order you see, that we don't know if that 5,000 lot you see, we don't know if it's actually a real order. It may be somebody trying to influence the market, trying to bully it, trying to push it around. They may actually be really long and they may put in a big bid to induce you to buy it ahead of them so they can go, bam, sold. I'll sell it to you. And I'll liquidate my position into everybody who thought the order flow was bullish. This is what they do. Order flow is worth billions, and at the same time, it is the biggest game of Texas Hold'em you have ever seen. But once it transacts, that cannot be hidden. Now volume cannot be hidden. Volume is real. Volume goes out on the tape. It's reported. And now we know what they wanted to do. So volume is the next leading indicator. Now with volume, a lot of volume doesn't matter. Just like I said with Citadel, with the small orders, they don't think it matters. So just trade it. We don't even care. Like we just make money on this stuff. We're not going to freak about it. Most volume doesn't really matter much. And what happens, and you see this in the behavioral psychology of traders, a market will go into a congestion and everybody will assume that that's fair value. And so price trades around fair value. I can buy it low and it goes up. I can sell it high and it comes down. People see this. So as prices rise, sellers get more excited because it's expensive and buyers like don't want to pay. So as prices rise, the bids disappear and the offers intensify. So bam, it comes right back down. Same thing on the low side. Market sells off. The sellers know this is too cheap, so they won't sell it. So the selling disappears and the buyers go, this is unbelievable. The bids start to show up. The bidding intensifies and the price goes back. So this keeps happening, where it just cycles around fair value, cycles around fair value. This can happen for hours. This can happen for days. This can happen for weeks. This can happen for months. This can happen for years. One of the reasons I was so bearish on the Japanese yen was it was in a 7-year trading range. 7 years. That's a long ass time to be in a range. Okay. That's how volume usually works. But every now and then, something comes along that's called impactful volume. An impactful volume disrupts fair value. Remember how we said prices rise and the sellers get excited to sell it? Well, I'll sell my 100 lot. I'll sell my 100 lot, 50 cents over. Yeah, this is going to be a great trade. I can make $5,000 on this. I sell my 50 lot, my 100 lot, 50 cents over. And then wham! I sell my 100 lot and I realized I've sold the first 100 of 10,000. Now there's a bid to buy 10,000 and I just sold 100. And guess what? I'm fucked. And my fastest approach is to get out right now. That's the best thing I can do. Have no ego and just turn around and say, I fucked up and buy it. And now I'm buying my 100 in the presence of somebody buying 10,000. Remember, I'm not the only one that sold it. They bought 2,000 from other people like me. We're all wrong, and the guy still got 8,000 to buy. So now we're buying our 2,000 back. He's buying his 8,000, and the market starts to go batshit. It starts to take off. In this moment, fair value is smashed, and it goes on the move. It's now unknown. And the market that was very stable and quiet is now very volatile and unstable. impactful volume leads to volatility. One of the things I see is very few traders have any metric of volatility in their arsenal. They have no way of measuring it. The best they have is a Bollinger Band. Bollinger Bands, you can do some good things with them. We actually use them in some respects. But you talk about being late. Holy crap. Bollinger Bands is about one of the latest things you could use. One of the biggest lags you will ever see. You take Bollinger Bands out, what do people use for volatility? Very few people have any kind of metric to measure volatility. But this is important because impactful volume leads to volatility. And this now starts to change the way the market behaves. Okay, I'm going to skip forward. We'll come on, and then we move to trend. Trend is very lagging. So people say, well, I trade with the trend. Yeah, I'm only going to buy when the trend's up. Well, the trend will be over, and you'll still be buying because you think the trend is up. The trend is over. Price action clearly told you it was over, but without knowing price action, when my trend's up, I buy pullbacks. Yeah, and you get run over and realize later that the trend was not up. Your indicator said it was, but it was super late. And then last is overbought, oversold. That's the latest. The market gets overbought, and it usually falls before the overbought signal is worked off.